but if the conversation gets there, the CRA and the IRS exchange information very regularly. So yes, US stocks, gains on US stocks are taxable in Canada. Bertrand, question. Yes, with respect to capital gains, we still currently have what is known as an inclusion rate of 50%. And that means that when you are taxed, they assess the gain, they exclude 50% and say, hey, take this for your risk, and then they'll tax the remaining 50%. So yes, your assertion is correct. Bertrand, taxes are based on your personal situation, right? So if you have not done anything to ensure that you will get a refund, then you will pay the taxes and that's about it. So you need to plan for a refund. If you don't plan for a refund, you will always pay taxes. Ayo, untaxed severance benefits in Nigeria do not appear on pay slips. I believe your employer would give you a notice, some kind of notice to say, hey, your time has been cut short, and on the back of that, we are paying you this as a severance fee. That is sufficient for anybody dealing with your tax returns to be able to include that in your personal situation. In terms of cash transactions, so this is something I'm going to address further on. When you have a cash-only side business, the question I ask you, I'm going to ask is most of the time is this. Are you looking forward to build a business, or you just want to collect the cash on the side? If you want to build a business, I would recommend that you start to record the income as well as the relevant expenses. And that is where the attention needs to go. Because when you have a cash business that is a side hustle, most of the time you will spend more than you make on it. And that should definitely be factored in your personal situation. When that is considered, you may find out that your taxable income is reducing, right? Meaning that you are more likely to get a refund as a result of this cash-only business. But we'll talk about that in a bit more detail. You mentioned intention being the basis for claiming home office expenses. If you have a business, based on what type of business models would the CRA consider as not having an intention to make a profit? So when it says not having an intention to make a profit, for example, you set up, the way your business is set up, you are delivering services that cost you more to deliver all the time. This happens a lot between foreign companies, where you deliver a service and then the foreign company charges you a fee over and above the cost of delivery. At the same time, they're only getting back that cost. So that company is not set up to make a profit, because whatever they spend, right, is what they get, but they still have more expenses out of that core, will I call it, cost of sales. On the back of that, that kind of establishment will be said to not have been set up for profit, which is why most of the time when you have those kind of transactions, you see the parent company paying an extra 5–10% on a consistent basis so that they don't fall into this kind of loophole. Bertrand, and they are paying so much. Yes, you have to plan for it. If you don't plan for it, you will not get it. Ayo, how do you plan for a refund? We'll talk about that. Tim, how do you plan for a refund? We'll talk about that. Does this give rise to double taxation? This is from Pearl, meaning the capital gains taxed in the US and no. So when you get taxed in the US, Canada would give you a relief for the taxation that you've paid for the taxes that you've paid in the US, right? Canada would give you a relief on that. And depending on whether you are taking the treaty route or you are taking the reporting route, you may either have to pay some taxes if that item is taxed at a higher rate in Canada, or you'll be able to cop out completely on the treaty and say, hey, I've paid taxes on this. However, this is a treaty country, and on the back of that, I don't have to do that anymore. Crypto trading. Crypto is considered an asset. So at least the last decision I know that the CRA made was to say any increase in profit on crypto trading is more or less considered like capital gain. So yes, there will be taxation, but it will be taken more from a capital gains perspective rather than like business income. So that's something to consider. Income earned in Nigeria before migrating it's not taxable. If you are not a permanent resident, you have no tax responsibilities in Canada. RSA pension in Nigeria is taxable. If you are making that withdrawal after you became a permanent resident, I think the safe assumption is that it is taxable. Bertrand. Yes, it's the job of your accountant to plan your return. So if your accountant is not helping you plan your refund, then you need to fire him. Hit the seventh car. Does the principle of double taxation treaty apply to Canada as seen in Nigeria and its arrangement with certain countries? Yes, so Nigeria does have a tax treaty with Canada. And on the back of that, there are certain instances in which you are able to get away with the fact that you've paid taxes in Nigeria. However, you are required to provide documentation to support that at the request of the CRA. So it's just important to line up the documentation. Ikena, do I need to register my cash-only business to be able to claim expenses incurred? This cash-only business is a sole proprietorship. You are the business and the business is you. So particularly if you are dealing with a business that does not require GST, if there's no GST number, all you're just going to do is report it on your tax return. That's all. Just put the income there, put the expenses there, and particularly if it is something that does not require GSTs, that just goes right in. You don't necessarily have to call to make a separate call and get a number unless you want to make a GST claim, which is a separate kettle of fish completely. Can crypto gains? No, well, I don't think the CRA takes crypto, so let's leave that. Bertrand, you talked about property tax. Well, it's quite rampant, Bertrand, what you are saying, but yes, they should pay taxes on the rental income. So let's return back to our presentation, which we still have a good chunk of time for. And at least I think I've been able to do a good job. 67% of us believe that salaries and wages are the most restrictive means of earning, and that is correct. And the main reason, as far as I am concerned, is the fact that you are not able to relieve any expenses without express confirmation from your employer, which is basically just not a thing for me. Labake, we'll come back to this last question. We'll come back to GST in a short while. We'll come back to GST in a short while, and it will be very high level. So let's go on to how you earn. So these are the things that I personally recommend. Number one, if you have a business, you will definitely make use of personal assets in that business. Until you get to the point where your business is big, it's huge and it's booming, you will most likely use your personal car to deliver the food. You'll most likely speak to your clients out of a space in your house. If you're an accountant like me, you'll most likely use a personal computer for a while until your business can afford one. You most likely use your bus pass to get to and from business meetings. All these personal assets or personal expenses that have business purposes are things that we do not capture. We are just not very good at it, right? So if you are using personal assets for business purposes and you are not recording the cost, then you really are doing yourself a disservice, because you are really not recording whether your business is viable or not, right? Then we'll talk a bit about registered investments in a bit, and then how you can tailor into your personal situation. So, but before we go that, I want to just juxtapose this. When I say the others, I'm referring to business income, rents and royalties, capital gains, and asset appreciation. All those things have the capacity for you to earn as much as you can or as little as you can. It is up to you. Whereas your salary is your salary is your salary, and that's about it. When you run a business or you have a rental property, or those allow you to write off expenses. And then the other two things are more lifestyle things, but there are also opportunities that are available to you when you are building from other quadrants apart from employment. Whereas employment provides you a steady paycheck, a good retirement plan, benefits plan, and then you really don't necessarily have to work too hard, right? You don't have to work too hard. You just do what you need to do to get the good feedback, and then they keep you on the job. So maximizing refunds in employment, I have to be honest, the opportunities are not very many. However, they are there. So first things first, please, if you're on this call and you're a salesperson, right, your primary job is sales. Whether it's a door-to-door kind of situation, or in sales, most of the time you're going to spend time facing clients. You're meeting clients, you're having conversations, you are trying to get them to buy whatever it is you're selling. You're using your cell phone, you're driving them back. All of these are things that your employer should be able to allow you to write off. So if that's not happening, that's something that you should look into. Now, let's talk about registered accounts. The most common registered accounts that will apply to most of us are the RSPs and the TFSA. I want to talk about the TFSA first, because in my view, it's the one that seemingly has no impact on your tax return every year, but it can be a life-changing tool if you use it properly. Now, your TFSA, like it says, is a tax-free savings account. What it means is that any money that you put into that account has been taxed already. Okay, so you're going to put after-tax dollars into this account. And those after-tax dollars in the TFSA are allowed to grow without the government ever looking there and saying, hey, you made 10% or 20%, we want our share. So imagine a situation where you put, I think everybody has about, I think it's about $6,000 now annually. I know it was 5,000, then it was 500, then 10,000, then back to 5,000. So it keeps moving. But every adult has a limit that they accumulate every year. It is cumulative. It doesn't stop growing. It's whether we use it. So if you have an amount that you can set aside there and you actively invest that money, if you are experiencing a year-on-year 10% growth and you are maxing out your TFSA every year, at the end of 20 years, you can change your life. I will talk about both the TFSA and the RRSP. So we're talking about the TFSA right now. So it depends on how you use it, but the important thing is, if you want to use a the usefulness of the TFSA is that you know how you are going to invest the money to get the return that is going to make that investment worthwhile for you. So, but if you asked me, I'm a high earning individual, I have a TFSA, I have an RRSP. Where should I put my money first? I would say put your money in an RRSP first. And this is why. So I'm telling you, I'm pivoting to the RRSP now, and I'm telling you why I think you should use it. Your RRSP is a fund that basically is you saving for retirement on your own. And you're telling the government, I'm going to be responsible. You keep CPP, you keep OAS, work on that. I'm going to work on my RRSP. So the government says to you, for putting this amount of money in your RRSP, I am going to give you 1606. So for putting this amount of money in your RRSP, I'm going to give you that money back dollar for dollar on your taxable income. So every year when you maximize your RRSP, what you are doing for yourself is that you are reducing your taxable income by the amount that you contribute into your RRSP. And what that does for you is that you get at least 18% of that money back, right? As a reduction on your taxable income, at a minimum, 18%. So my advice as an individual, if you are in the, say, 60K and up range, I would say every year, max out your RRSP, even if it means you borrow marginally. Borrowing for RRSP is most of the time is at prime, right? And whatever it will cost you to pay back, maybe you have an additional $1,000 or $500 off every paycheck that you use. Max. So your RRSP contribution room is 18% of your income to a maximum of, I think, about $26,000, $27,000 right now. But that's really what that's about the same rate of what you're going to get back when you file your taxes. So the point I'm making is, if you are earning between $60,000 and up every year, I would recommend that you max out your RRSP, because that starts to build the boat for you to get money back. And don't forget, that RRSP contribution is yours. It is sitting there. If you withdraw it, the government will tax your withdrawal. If you withdraw it in tranches of $5,000, they will take only 10%. If you withdraw it in larger volumes, the taxes get higher. However, it's something that you need to, if you're going to draw from it at all, you need to think about. But the other benefit of having an RRSP account funded is that if you're going to buy a house, you are allowed to borrow as much as, I think, $20,000 or $25,000 from your RRSP as what is known as a home buyer's plan. And you have 15 years to pay that back. So even if all you are saying to yourself is, I want to buy a house in 3 years, and you keep maxing out your RRSP every year for the next 3 years, at the end of 3 years, you have more than $25,000 in your RRSP contributed. And you can take that $25,000 out, make it part of your down payment to buy your house, and that gets you going. Oh, is it 35K now? Okay. Yeah, so I hear it's 35K. Now, so that's for the home buyer's plan. Another benefit of having an RRSP is that if you want to go get tertiary education, right, you can actually fund it from what is called the long life learning plan, which is also a loan that you make to yourself from your own RRSP. These loans do not trigger a tax bill, unlike if you just withdrew from the RRSP straight off by yourself. Okay, So that's one thing I want to draw our attention to. The home buyer's loan has also been increased to 35,000. Okay, fantastic. So those are key things, but those are levers that we can use in making our RRSP contributions that can be beneficial to us as employees. Now, when it comes to donations, you're allowed to give out as much as 75% of your taxable income in donations, and the government is going to say, okay, for every dollar that you give out, I'm going to reduce your taxable income by that amount. Now, of course, this is money out of your pocket. So it's just something to think about if you have those kind of commitments or you have interest in them, right? Then, of course, your tuition in a post-secondary institution gives you a measure of tax benefit. So, for example, you are an accountant, you're writing your CPA exams. The CPA is going to give you a T2202, which states the number of months of full-time or part-time education and the tuition that you paid, which gives you some measure of tax credit. If you are doing a master's degree or any kind of post-secondary degree, the educational institution that you're attending in Canada would definitely give you a slip for tax purposes, which you will be able to claim. And those amounts are available for you to relieve it against your income into perpetuity in future. Some schools outside of Canada are also in on that, and they're able to provide you a slip. However, you can only claim as much of this as your income would allow. So if you don't earn too much, you can claim some now, defer the rest, and you keep deferring until you're able to relieve everything. So these are the clear opportunities that are available for you when you are an employee. There are not too many, but the fact is many of us are not even using them at all yet. So let's start with this. So I'm just going to put out a scenario to show, okay, what it would look like as an employee. So say you're an employee earning $100,000. These numbers are hypothetical. They're not exact, but it's just to give a perspective. You pay $26,000 in federal taxes, CPPEI, another $3,300. That brings us to about 29,000 and change. So you end up with cash flow of $70,700, right? So you can just bear this in mind. I'll come back to the questions, but keep them coming. Keep them coming. Thank you. So you have this employment income of $100,000, and these are the deductions, and that's it. That's it. So after this is from this $70,000 that you fund your lifestyle, fund your provincial taxes, as well as your savings for your down payment, whatever it is. All of that is funded out of this. So let's go on and talk about Labake's question earlier about that cash-only business. So the 3 dots there, you can read it as off books. Now, when you are self-employed or an entrepreneur or an independent contractor, first things first, you are the business and the business is you. Everything relies on you. So you build certain life skills, like the ability to sell, like the ability to go after a goal, pursue it, and achieve it. Those are key, and they are also very useful when you are in employment. However, like I said earlier, when you have personal assets and you use them in business, and you do not consider what those personal assets cost you, then you are not taking advantage of your position as a business owner. So look at all these things I've highlighted. These are just things that I have picked out off the top of my head. You have a car. You use your car in your business. You do a huge chunk of your business in your house. Your cell phone bill, mortgage interest. You attend an event that's related to your business, the travel and hotel accommodation. All those things become valid business expenses, which if you relieve against this cash, right, is going to leave you in a position where your taxable income is going to reduce. But if all you just do is you take the cash and that's it, then that's it. So all these other things that should be beneficial to you from a tax perspective, you can't use them because you are not declaring the income. So my counsel is, take a look at your situation, talk to your accountant, and make sure that you are getting the best possible position from a tax perspective for any kind of business endeavor or enterprise which you have entered with the intention of profiting. Because whether you are making a profit now or not is irrelevant. As long as you there's a potential for profit and you have expenses, you have a right to relieve your expenses. Even if all your business is doing is paying your cell phone bill for the whole year at a minimum. Now, imagine a situation where, let's see, you are a real estate, you're a realtor, right? Realtors have these massive events in beautiful holiday spots like Florida and California and Banff and Victoria Island and all those kind of nice places, right? Now, if you don't think about it, you will take those, that you just go on your vacation, come back, then you take off and go for your conventions, quote and unquote. But imagine a situation where you go to the same location for business at the same time for your vacation, and you're able to relieve, say, a nice 50 or 60% of the cost of your vacation because you can tie it to clear business activities that happened while you were there. Those are the kind of opportunities that are available to you when you are self-employed and you are thinking about and planning your taxes. So this is where I wanted to draw attention to, because the fact is, if you are not capturing your expenses properly and relieving the right amount of expenses, you are paying too much tax. End of story. That's my perspective. And that's how I go about tax preparation and tax advice. So think about your situation properly, assess the basis for which you are earning, assess the personal assets and expenses that are involved in you earning that income, and then see what the impact is when you represent it properly in your personal tax situation. Keep the questions coming. We'll soon be back there. So this is what your position would look like in a self-employment, sole proprietorship situation. Suddenly you have $10,000 in expenses that you're able to relieve. And this $10,000 is money that you would still spend as an employee. So it's still your cell phone bill. It's still a portion of your home expenses. It's still a portion of your car usage. It's still the education that you'd have gotten anyway. It is the networking meetings that you went for. It's the mastermind group that you joined. It's all the coffee meetings that you had with potential mentors, investors, advisors, employees, partners, and staff. So as long as you don't capture those kind of things, then you don't have anything. But once you start to consciously record them and consciously capture them, you find out that your business starts to pay for your life even before, quote and unquote, you are pulling out a dividend or paying yourself a salary or those kind of things. So I'm going to show a brief example of one thing that can help you which is how if you are using a motor vehicle. So Murray has a December 31 year end. He owns a truck that's not a personal truck. He uses the truck to pick up supplies and equipment. He kept the records for his fiscal period. Note that, because that is important, the record keeping. If you don't keep records, relieving expenses is difficult. But if you keep records, then you have something going. Yes, keep the dishes does count as a business. It is a business, please. Don't miss the opportunity. Sorry, you got my attention. I'm going back. Now, he traveled 27,000 kilometers to earn business, but he drove a total of 30,000 kilometers. So on the back of that, to get to 30,000, he spent 3,500 on gas, 500 on repairs and maintenance, $1,000 on insurance, 1,900 on interest, another $100 on license, total $7,000. Murray owns the truck. The truck doesn't belong to the business. But because he's kept this record, he's suddenly able to write off $6,300 against his business. Now, even if all his business made was $200, right? Because he has this record, he's able to write off $6,300, and that suddenly improves his personal tax situation because he's carrying a loss from his business and it is flowing into the bucket of employment plus business plus rent or property plus capital gains, and that is what forms what we call taxable income. So I want to drive home the point that maintaining a good record is important. Thinking about your situation and making sure you capture every expense that should go into your business is also important. Those are things that can change your situation significantly. But if you don't think about it and you don't document it, then it makes it difficult for you to be able to prove it to me as your accountant, much less prove it to the CRA when they come at you in an audit situation. So that's something I definitely want to draw attention to. At the same time, I'm just going to go back to the questions, answer a few more before I proceed. Okay. So what are the pros and cons of not declaring to the CRA the entire business you do in Nigeria for worldwide income tax purposes? It's at the end of the day, it comes down to your situation. When you find yourself in a situation where, for example, you finish your school and then a year later you come back and say you want to buy a house, and then suddenly you're waving all this cash around, but you've been a PR all the while and you've not declared any of the income, you find yourself at cross purposes. So your asset acquisition is hampered simply because you're not declaring your income. And that is always very important at this first 5-10 years phase, where you're trying to acquire assets and plant your feet down and set up a life properly. So that becomes very important. So it's something just to keep in mind. I want to highlight the fact that, like I just said, asset acquisition and tax minimization are two goals of any taxpayer, but they are at cross purposes. So every time that you're focusing on asset acquisition, which means you need a lot of income, you can't focus on tax minimization, because tax minimization means you're trying to minimize your income to get to taxes. So you can't do them simultaneously. You need to focus them on focus on one at a time. Tax-free investments, Jayoku, tax-free investments like government bonds from another country, can they be taxed in Canada? I believe they can be, because in Canada they are not tax-free. So unless Canada's equivalent is tax-free, I believe the government of Canada will want to tax it. Let me go down a bit further. Does post-secondary classes done in a registered school qualify? I believe so. If the school is registered, even if it's a trade, they should be able to provide you sufficient because it's post-secondary. CPA conversion, I believe the CPA will provide you a slip for this, so you can claim it. Refund for CIMA registration and exams. Now, I don't think CIMA is a Canadian organization, but if they have ties, if they have a relationship with the CRA, they should be able to provide you something. So when it comes to education, well, I did the CFA a while back, and I know I couldn't get a tax credit for that. So that much I can speak to. The BA course, it depends on who is offering it. If just an online course, I'm not certain that you'll be able to get anything for that. Now, this 2020 ICANN membership subscription, I don't think it would fly. So this is my thought. Professional memberships, most of the time, when you need your professional membership on your job, your employer would pay it, or they would ask you to pay it and you'd get a reimbursement. When you have a professional membership that's not required on your job and is not required by a provincial government, the likelihood you'll be able to relieve that is low. So that's what I am aware of. Or 4C, for a PR from April 2019, am I to report income between January and March? No, January to March 2019, you did not have any ties to Canada because you are not a permanent resident. And what you would report in your foreign income section would be your post-landing income, which is April. And you report if any income you've earned abroad, as well as any taxes that you've paid abroad. How can one file taxes or income received from an offshore client for job done here in Canada? Freelance jobs. So personally, I would say this should be done as a business. Jibola, this should be done as a business, not as from an employee perspective. So you would have invoices which will show the income you've earned, and then you'll be able to relieve the relevant expenses. Skip the dishes is a business. Please make sure that you relieve the expenses required before you file that tax return. Joint RRSP, I don't think, Samuel, I don't think this makes a difference, whether it's joint or not, because what I know is that you can open what is known as a spousal RRSP, which means one spouse is contributing to the other spouse's RRSP, right? That's what I know you can, but I don't think I'm aware of a joint RRSP. Isaiah, is day trading allowed in a TFSA? So most of the stocks that you typically want to day trade, which are momentum stocks, high volatility, are prohibited in your TFSA because they don't want things that will be wiped out suddenly. So, but you can take another look at that. For you to do skip the dishes, Shegun, I believe you are registered. So once you are registered and you can carry on your activities, you don't need to register with this. There's no specific registration you have to do with the CRA again. Just go ahead and make sure that you document, and then you include it in your tax return. Labake, can one apply professional judgment in estimating a reasonable portion of some of these expenses without necessarily keeping a record? So in terms of you said mileage, let's address mileage for what it is. The standard for mileage is pretty stiff, which means that they expect you to record the mileage at the beginning of the year, the mileage at the end of the year, and then the mileage for business. But the beautiful thing is there are many apps out there that will capture, how far you traveled every time your car moves. So, and those apps would allow you to download the mileage into Excel. That's the kind of thing that you can pick up, put on your phone. At the end of the year, you download it, tick off business, personal, business, personal, business, personal, sum everything up, and then provide that to your accountant as part of what goes into your tax returns. ACCA subscription. I believe the ACCA has a relationship with the CPA, but I'm not sure if they have with the CRA, so I can't say that. I can't speak to that. If you work 2 jobs, you make more money. As long as you, on the back of that, probably you end up with a CPP-EI overpayment. However, that's not a lot of money. The important thing is that you are taking the steps to make sure that you are using your situation, RSP contributions, relieving education. If you are doing anything business related, relieving expenses as well. What about income that has been taxed in Nigeria? Because that income has been taxed in Nigeria, you will get the benefit of the income that you've paid in Nigeria. However, if you pay more taxes in Canada, if you earn that income here, then the CRA will be expecting you to pay the balance. That's what I have seen more often than not. GST, we'll touch on it briefly before we are done. So if you filed your taxes and you do not include your education, you can still include it next year. The important thing is that you have the documentation just in case the CRA asked for it. Yes, Flo, thank you for bringing this to my consciousness. Your RSP contributions are based on a contribution room. That contribution room is 18% of your employment income from the preceding year. You are allowed to contribute that amount and to an excess of $2,000. When you contribute more than $2,000 over your contribution room, the CRA will tax it with a penalty of 1% per, I think it's per day or per month, something pretty punitive. So no, over contribution is a no-no. You do not want to do that. I have assets that I want to dispose of and move. Do I need to declare these assets? The expectation is that you should have declared those assets at the point of landing, so that it's at least with your first tax return, say, hey, I have these assets that I acquired before I became a PR. This is the market value as at the date I became a PR. Maintain that record, right? When you file a T1135 saying that to the CRA and you maintain that record, when you dispose of the assets, if you dispose of them at the same market value, nobody's going to tax you. If you dispose of them and make a capital gain, then the CRA is going to want to tax 50%. So that's how that will work. But it's in your interest. If you don't declare them, well, nothing may happen, but something may happen. So to avoid that likelihood that something happens, I would say go ahead and put in that declaration. Hits the 7th car, CIA exam fees, I really can't tell. I don't think they have a relationship, so I can't speak to it. So back to the slide, sole proprietorship versus incorporation, just a quick contrasting, right? Your sole prop, anything you make on your sole prop, if it is income, will be taxed at your marginal tax rate. So imagine a scenario where you earn $100,000 and then you have a side gig that earns you an additional $20,000 and you don't relieve any expenses. Suddenly you are going to be paying taxes on the $20,000 at the highest tax rates that you have, which is probably around 26% for federal tax. Add another 10%, 10.5% in Alberta on top of that, maybe even more. You find yourself paying out 36, 37% out of that $20,000 as taxes. That's just not worth your while. However, it's still better than, earning that whole $120,000 as salary, because you at least should have been able to relieve some expenses. Business losses reduce taxable income. I've been harping on this and I keep saying it because I believe that is actually the biggest opportunity when you have a side gig. Your business loss reducing your employment income minimizes your tax. So I'm just reiterating that again. Your sole proprietorship is an unlimited liability. If anything goes wrong there, and there's somebody sues you or something, all that's going on you. So that's a headache. When should you run a sole prop? It's a new business making a loss. That's when it's beneficial. When your sole prop is making a profit, it's no longer worth sticking to that structure. It makes sense at that point to begin to consider transiting into a corporation. Why? Because the corporations have a lower tax rate. Corporations outside of the larger listed corps that don't have the federal abatement pay taxes at a maximum of about 15%, some as low as 11%. So it just makes sense to use that vehicle. However, there's no direct connection between your personal tax and your corporate tax. They are two separate things. So once you incorporate, the only relationship that you have with the company for tax purposes is either you are drawing a dividend or salary, right, as income, or you are loaning money and then you have to pay back. So those are things to think about. The corporation has limited liability, which is beneficial. So what I reiterate again, when your business is profitable, then you should start to consider incorporation, because there's no point paying income, particularly when you have employment income. So if you have employment income and then you have business income in a sole proprietorship, and that business income is profitable, then you should start to consider incorporation, because you are paying taxes at the highest marginal tax rate for your person. And then, of course, as a corporation, you can secure credit outside of your person, your individual name, which is always a good thing if you know how to manage credit. So I'll present the same scenario, this time looking at it as a sole prop, if you are earning from a corporation, right? So the corporation made $100,000. You spent $15,000 to make that happen. Then you relieved another $10,000 or more of personal expenses, which have a business purpose. Please note, when I say personal expenses, I mean personal expenses that have a business purpose. You need to be able to show that there's a business purpose to these expenses. Of course, your corporate rate is lower. It's about 15%. So you have that profit of $63,000 and you have a dividend. You pay yourself a nice dividend of $50,000. The company still has $13,000 or almost $14,000 in retained earnings. However, if you take a look at the cash flow side, first things first, as a business, you're providing rateable services on which there is GST. You collect GST. That's $5,000 in cash flow that you haven't done anything for, right? So all that you spent on the business was $15,000. There's $90,000 in cash flow in the business. You pay out your taxable income. You pay out your taxable income. You pay out your taxes. You have a net cash flow of $78,000. You pay yourself a dividend. The business, after you've paid GST, so I'm assuming there's GST on both the revenue as well as your core business expenses and your relevant expenses. So when you relieve that GST, the dollar amount you're going to pay out as GST is even lower, right? And as a result of that, you're able to come away with $25,000 in cash flow for the business. That's after you've pulled out $50,000 from this same business. So when you look at it, at the end of the day, you are ending up with as much as $71,000 from the business out of the $100 that you made in your pocket, and you've paid out all your taxes, right? And you've relieved your $10,000 personal expenses to boot. So when you look at it from that perspective, it's just clear that being a corporation is just beneficial, really. And I keep harping on this, so I'm going to go back one slide. Right here, core expenses, let's see if I can. Okay, sorry, I can't do this. Your core expenses, relevant expenses, those numbers are determined by how much you know and what you can do, right? So as long as you can generate the top line, your ability to relieve expenses is basically your biggest tool, which is why I keep saying being aware of what you can relieve is so important. It's so important. And it has such huge potential to impact your situation. So in my view, it's not the rate that's the best part, really. Although the rate when you're a corporation is fantastic, but that's not the best part. The best part is the ability to understand the expenses that you can relieve and plan your life accordingly, such that you are using your lifestyle, which is what this was all about, right, to generate cash flow for yourself. So at this point, do we have any further questions? Does what I have said so far make sense? Flo, with incorporation, is there a way to avoid double taxation, being taxed as an employee of the corporation as well as being taxed, as well as tax of the employee's entity's profits? So as far as the government is concerned, this is not double taxation, because you as an entity, you are a separate legal entity from the corporation. So as far as the corporation is concerned, the corporation is taxing you for your activities, and the corporation is taxing the government is taxing you for your activities in the corporation and taxing the corporation for its operating activities. Those are two separate things. So it's not taxation, it's not double taxation. However, the way to minimize that is something that is part of what we are trying to achieve with this conversation. To say, okay, when you own a business and you work in the business, you need to be aware that there are opportunities for you to remunerate yourself, and you need to make sure that you are using the best possible opportunity. So should you be taking a salary or should you be taking a dividend? Is there a benefit to either? Right? Those are all considerations, and those are things that you need to ask yourself and discuss with your accountant and get a good view on. If your accountant is not having these conversations with you and you own a profitable business, think twice before you continue your relationship with him. Collins, you're right. You're right about your observation. That's me. Yeah. No. Okay, so let me explain what I mean by this. The 15% tax is coming off the earnings. It's your earnings that determine how much tax you will pay, not cash flow. So even though it's 15%, the 15% is determined from the earnings column, and you will pay that out. So that's why I use that. So it's not wrong, it's right. Taking a dividend or a salary would depend on your situation. So if, for example, you have no other income and you're making all your income from the business, right? I would say take a dividend, take a salary up till what, maybe like 40 grand, because that will use up your personal allowance completely. At the same time, it won't generate too much of a CPP-EI bill, which can be a painful thing when you're a business owner. And then you can take the rest as dividend, because that doesn't trigger CPP or EI. But if you want to contribute to those two funds, then yeah, you might as well go ahead and take your income through the salary. But like I said, it comes down to the specifics of your personal situation. So I would say sit with your accountant, take a look at your situation, and then that will drive the answer to that question. So your TFSA doesn't show up in your tax return for any purpose other than the contribution room that you have. So if you're going to put anything anywhere, it's just going to be the contribution room. Nobody cares about the market value of your TFSA because they don't want to tax it. If you want to know your RSP contribution room, take a look at your prior year tax. Yes, that is definitely the same thing as the deduction limit on your notice of assessment. Femi, you are correct. Your contribution room is the same thing as your deduction limit on your prior period NOA. So if you look at your 2018 NOA, you see your 2019 contribution limit. Any more questions? We can make some progress here. So these are a few Infinix Note 5. We don't need to worry about that. So Femi, this is something that I expect to happen this year. So with the whole COVID-19 situation, I expect a lot more employers than ever before to issue their employees T2200s to say, hey, you are allowed to relieve the cost of, particularly if they did not provide you any kind of allowance to set up a home office, you are allowed to relieve the cost of the home office that you set up to use during this period. I expect to see that happening. That's how I expect this period to play out, right? So I would say if you've spent any kind of money, setting up a place that allows you to be able to work from home, it makes sense to put that money together, either have a spreadsheet, have a listing, keep some receipts aside, so that way you can, say to your employer, hey, I spent all this money, I believe I can relieve it against my taxes. I will need you to approve it and give me this slip, right? So that's what I expect to happen more this year than ever before. And of course, COVID-19 is the reason why. So that's how I expect the government to handle it. But let's see, we are still dealing with all the emergency money at the moment. Carlo Tinto. So at what point do you declare your stocks when coming in? I think the first opportunity you have for that really is when you file your first tax return, honestly, because I personally, I'm asking myself, I don't remember back then at any point until when I filed my tax return, anybody asking me to do an asset declaration. So I think it's going to be at the point of you filing your first personal tax return. Jabbar, I have been a PR over a year and I've never received GST. Can I claim the backlog? So now, are you talking about the GST credit? If you're talking about the GST credit, that would depend on your income level. So my thinking is that you're earning pretty well, and because you're earning pretty well, they don't think that you should be getting one. So you're out of the league for that, right? So that's how that will work. Does medical expenses from a visiting parent from Nigeria impact your tax returns? No. Unless they are a permanent resident, at which point that will now be on their own tax return. But you said visiting parent, so it doesn't have any impact. You are paying out of pocket for that. What if you have just used your personal laptop and home internet for work? How do you estimate the cost? You bought the laptop for a price. The average laptop is a 2-year depreciation thing. You pay for home internet on a monthly basis. Yeah, just estimate a number that is going to be deemed to be reasonable for what you want to expense against the money that you're making from sitting at home on your laptop and internet doing the work. So I think the important thing is for you to have a justifiable basis that is reasonable. And it's important that you document it. So your laptop costs $2,000. You depreciate it over 2 years. That's $1,000 per year. You spend $100 on TV, home phone, internet every month. And to your mind, you spend more than 3/4 of your internet time on the business. Then you can charge 3/4 of the cost to the business. And as long as you can document it and support it and it's reasonable, then go ahead and do it. And that's how that will work. Okay, so I'll proceed with Tales by Moonlight, if that's fine with us. So we are on pace to be able to take another solid Q&A session at the end. So let's just proceed with this. I'm new in town, I have no income, so I'll get money from the government. Yes, you will get money from the government, but the money won't come as a tax refund. The money will come as social welfare, which is basically, i.e., you are low income, so they recognize that and they give you a GST credit. They give you the opportunity to buy a bus pass at a low price. If you have kids, they give you money for CCB, right? But if you don't have any of those things, you are not going to get any money. So whatever money you will get will not come from your tax returns. Yeah. So I just wanted to put that out there. Do you need, from Dami's question, do you need to present the receipt of the laptop? If you have been audited and the CRA asks for it, yes, please, you need to. So please keep a copy. Whether you take a picture and store it on your Google Drive, or you take a picture and or you take a copy and stick it in a shoebox, it depends on you. But make sure you have a copy in case the CRA calls upon it and says, hey, we want to audit you, right? CAI, is a climate action incentive that is being paid this year. This is the first year that the CIA is being paid by the government of Canada, and they are going to pay to everybody who was a PR as at the 1st of January 2019. If you landed in the course of 2019, you will not be getting the climate action incentive. And it's depending on your family size, it's anything from $444 for a single individual to as high as $999 for a family of five. Yes, for a family of 5, 2 spouses and 3 children. So it's 2 spouses get $666, and then $111 for every additional child. Glenn, do I pay tax for 2019 if I landed in November 2019? Yes, sir. For November and December 2019, if you earned income in Canada, then yes, you are expected to pay taxes. Now, let me paint out how ridiculous it can get. If you landed on December 31, 2019, you are expected to file a tax return, even if you earned no income. Okay? Then I hear that the climate action incentive is there's a provincial component to it. So it may not be that high in your province, but I'm speaking to what I'm aware of in Alberta. Even if the CIA started in 2018, it didn't start it's not in this current form, no. I'm not aware that I had this very obvious current form in 2018. Okay. Then the other one that is very common, this one has been there forever. I can take CCB even though I have a good paying job. Fine, yes, you can, because CCB is determined based on your income for the preceding year. So the CCB is Canada Child Benefit, right? And when you earn, the CCB year is not the calendar year. The CCB year is July to June. So CCB for 2020 July to June 2021 is based on your 2019 tax returns. So if you landed, say, in January 2018 and told them that I earned X Naira in Nigeria, which they converted to dollars, and it turned to be such a tiny amount, and they decided to pay you CCB from almost immediately in 2018 till July 2019. Now, if you happen to have gotten a more than decent job, literally like a month or two after you arrived, you are still going to continue to collect that CCB. However, when you file your tax returns for 2018, which I believe is the example I'm giving, they will take a look at it and say, hey, you made all this money and you no longer qualify for CCB, and we want you to refund everything from when you started making this money, right? So that's just something that we need to consider and bear in mind. So yes, you can take it, but if you no longer qualify, they will identify that point from which you no longer qualify, and then they will ask you to make a refund. Okay? Any reason why the CRA may choose to audit someone? They select randomly. I'm aware of that. I'm aware they select randomly because sometimes they pick big earners, sometimes they pick small earners. However, there are also factors that can basically just draw you to them. So suddenly your income drops significantly and it doesn't make sense to them. Those kind of things, they can ask questions, right? So it just depends. But generally speaking, it's supposed to be a random thing. Is CIA a recurring thing or just a one-off? I think for now, with the direction that Canada is going, we'll be having some sort of climate action incentive unless something changes. But right now, everybody thinks it makes sense to support, so basically do something about climate change, and that money is given to you on the premise that you are not buying plastic bags, you are trying to switch over from wasting energy to renewable energy in some formal way, fashion or other, that kind of thing. So that's why that's happening. So I expect things to keep going that way. Collins, I think you can claim some eligible expenses for your visiting parents. Okay, I'll take a look at that, but that's not something that I have seen as practice. Yes, I do prepare personal taxes for first-timers. I do provide personal tax services, basically. So whether we're first-timers, you've been here for a while, you need support, we can definitely do that. So we can talk about that. Is medical and dental expenses covered by your insurance claimable in the medical credit? So for the medical credit, you can claim vision, dental, you can claim medical related travel. So for example, you try to schedule a surgery in town and they told you it was going to take 4 years for it to be your turn. And the doctor told you die in 2 and you decided to go to Mexico to have it done. That entire trip, you can actually include as part of your medical, at least use that to relieve against your medical credit to say, hey, I had to travel for medical purposes to this location. This is how much it cost me travel and living expenses to be there. So that's definitely something to be aware of. So as far as the Canadian emergency relief funding that is currently available, that will open on Monday, the few things that I'm aware of are that you need to have earned some money in 2019 to qualify, $5,000 to be precise. And there is opportunity, but at the same time, it's not as wide and free as it sounds like. So So on the back of that, I would say the best thing to do would still be to get on the website and then look into your personal situation. You'll be able to apply through CRA My Account for it starting on Monday. Am I able to claim taxes paid on gym membership? No. Gym membership, club membership, all those kind of things. The CRA, as far as they are concerned, is your problem. So they don't care about that. They don't care for that. I didn't make up to 5K, but my wife did. Can I ride on that? I'm not certain. I know that there will definitely be some kind of funding for people who did not make the 5K mark, but which is why we have a plethora of programs. But this one that I'm talking about requires a 5K limit. So if I travel to the US for a dental procedure, can I claim it as a deduction? You can utilize that cost as, at least put that on your medical credit and see how much you can get back. How does childcare expenses affect your tax refund? So because not everybody falls into that bucket, I didn't include that. But yes, if you have childcare expenses, you can relieve some of them. Off the top of my head, I can't tell you how much, but definitely it helps your position because that's an expense you've incurred and the government is willing to give you some of it back. Thanks, Ola, for sharing that information. That's very key. But I think the CRA My Account makes it most, if you have access, if you have your CRA My Account set up, that's easiest because you can read the information, you can access it, and you can put in your application there. I'm sure the phones will be burning on Monday, so it may not be a good time to sit on the phone. The CRA is a call to the CRA is a 1 hour, 1.5 hour waiting time phone call on any business day. Monday is not a day to want to do that. If expenses, Flo's question, if expenses are covered by insurance, I don't think a claim can be made. Okay, so let me go back. So just in case I've said something. Okay, so I need to clarify that. Bill, I was assuming that you are talking about the uninsured portion of this medical and dental expenses. Because what I've seen is, typically you get a pair of glasses, it costs you anything. If you're like me and your eyes are really bad, it costs you, your lenses cost like $500, $600 alone. And your coverage for 2 years is what? Less than $300. So you have a clear $200-300 gap. Now that you can relieve against your taxes. So that's what I was referring to. Not that you would have claimed the money from Sun Life and then you want to put that in your tax return as well. That will not be appropriate. I hope that's clear. Does it mean I can use my Nigerian income to qualify? No, sir. Shegu, that is not correct. You cannot. You can use it's Canadian income that they want to see. So, Chooks, please DM away. DM as much as you want. I am available to take your questions outside of this forum. Okay. Childcare expenses are, yes, that's correct. Can I open CRA account without? I assume that's without. No, you need to file your first tax return before you can have a CRA account opened. Then I understand you can only claim the emergency relief fund if you lost your income as a result of COVID and not just normal circumstances, whether or not you meet the 5K minimum. So, which is why I said there are a number of those plans out there. So there's the EI related one where there's a quicker turnaround, as well as the emergency relief fund where you have a 5K minimum income, and then if it's not normal circumstances as well. So that's correct. Your insurance contribution is not deductible, Bell. That's my understanding. You can't, your insurance as an individual, you can't deduct your insurance contribution. No. for tax purposes. No. Okay, so back to my slides. I think this is just where I'm going to hang it and say, whatever you do, there's no free lunch. If you take money you're not entitled to, they will come back for it. That's just the norm. I remember the first time during the NDP government, they had this thing called ACLA in Alberta that the government was paying out. And based on my income, based on my filed return, I think I got 3 or 4 payments. And then I was reassessed. And then they took back the whole 3 or 4 payments. That's how it works. So it's best to take a good look at your situation and make sure that you need that money that you're about to take before you take it. Because if you take it, they may want it back at a time that is absolutely inconvenient for you as an individual. So it just makes sense to, it just makes sense for you to assess your situation properly and say, hey, this thing that I'm about to do, would it work in my favor or can it burn me in any way? So based on that assessment, then you can go ahead and say, yeah, I will, or no, I will not, right? So if you have any questions, please send them across. That's pretty much all I have at this time, as far as information is concerned. But I think I will still go back to reiterate that the best thing you have about a business is your ability to write off your expenses. The rates are great, yes, but when you make the most of your personal situation and apply them in your business situation, so you're planning your vacation around it, you're planning your weekends away around it, you're planning seeing your clients around it, you're planning lunch and date night around it, you'll be surprised at how much value that you can add to yourself if you think about it properly. So that's all from me. I will return to the slides where we tell you who we are. My name is Dotun. I'm part of this group called Side Gigs and Extra Bar. Our goal is about knowledge, personal development, and financial development. These are some of the brands that are currently represented within Side Gigs and Extra Bar. We are not a company, we are just a group of guys. But these are companies that are coming out of us, that are represented within us. And yeah, I hope I've made your afternoon a bit more worthwhile. Thank you to everyone.